Hey everyone, welcome back. If you're ready to get absolutely laser focused today, we have an incredibly powerful explainer lined up for you. We're diving into a complete master guide to understanding market structure, built specifically for beginners. Together, we're going to demystify the apparent chaos of those charts once and for all. So if you've ever stared at a stock or Forex chart and felt, well, totally lost, you are in the exact right place. Let's start with a really fundamental question. Is price action just random chaos? I mean, to the untrained eye, stock charts just look like unpredictable squiggles, right? They're spiking up, crashing down, seemingly without any rhyme or reason. But here's the secret. There is actually a deep, highly mathematical language behind all those movements. It's not chaos at all. It's a remarkably structured footprint. To really set the stage here, our source material highlights this truly fascinating perspective. Capitalism rules the markets in much the same way as the law of gravity rules our planet and lives. Think about that for a second. The market is governed by eternal, undeniable forces. At every single moment, buyers and sellers are locked in this constant, never-ending battle, simply trying to agree on a fair price for an asset. It's just like gravity. Okay, let's quickly run through our roadmap for today. We'll kick things off with the market's hidden language, then move into supply, demand, and imbalances. After that, we'll unpack the anatomy of zones, look at the three market phases, decode market structure breaks, and finally wrap the whole shebang up with the power of confluence. All right, let's jump right into section 1, the market's hidden language. You can think of this part as learning the alphabet of smart money concepts, because before we can read the actual sentences on a chart, we have to know the letters, right? And the absolutely most important letter in that alphabet is institutional order flow. These are the historical footprints left by the big market players. We're talking the massive banks, hedge funds, the major institutions. These players move so much volume that they quite literally cannot hide their actions. Understanding market structure is really just tracking these massive, undeniable footprints that reveal true market conviction. This is the one concept that ties absolutely everything else together. Moving right along to section 2, supply, demand, and imbalances. This dynamic is the core mechanism of price movement. It's the eternal tug-of-war that actually prints those red and green candlesticks on your screen. To make this super tangible, let's use a quick farmer's market analogy. On the left side, imagine a day where every single farmer shows up with an overabundance of tomatoes. There's this huge glut of inventory, so what happens? Well, they're forced to slash prices just to attract buyers, right? That creates a supply zone. Now, on the flip side, imagine a sudden shortage of a really highly sought-after fruit. Buyers are going to eagerly pay higher and higher prices until the very last one is gone. That is a demand zone. Your financial charts are honestly just a digital version of this exact dynamic.
And this constant battle to find balance is what creates the actual structural zones on a price chart. When demand heavily outweighs supply or vice versa, the market tips and it leaves a permanent trace. It's those exact historical areas of massive imbalance that we actually want to trade against.
So, the absolutely crucial point here is understanding how these zones operate in practice. A demand zone acts as a hard price floor. This is where demand totally crushes supply, leading to an intense buying rally. Conversely, a supply zone acts as a price ceiling. This is the spot where a massive wave of sell orders completely swamps the buyers and prices plummet. Identifying these historical price areas helps us anticipate exactly where the big players are going to step back in to defend their positions. All right, section 3, the anatomy of zones. Let's look at how these are built. Our sources outline a very simple 3-step sequence for how a high-quality zone is formed. Step 1 is the impulse move. This is a very strong, sudden directional push. Step 2 is the base. This is a brief consolidation or a little pause where massive orders are quietly accumulating. Finally, step 3 is the departure. That's an aggressive, explosive move away from that base. Listen, that base is exactly where you must draw your zone lines. That base is where the smart money footprint is hiding in plain sight. Next up, section 4, the 3 market phases. Now we're moving up to the sentences of our market language. A market can really only do 3 things. It can be in an uptrend, making a series of higher highs and higher lows. It can be in a downtrend, making lower highs and lower lows. Or it can be in consolidation, which is just sideways movement building up liquidity for the next big move. Now here's a major pro tip. Picking a single time frame, like say the 1-hour chart, is absolutely crucial. If you constantly jump around between time frames, you're going to get completely lost in the noise. Pick one lane to define your trend and stick to it. Within those trends, we really need to talk about dominant versus subdominant players. In an uptrend, buyers are the dominant players. They are firmly, undeniably in control. Sellers are subdominant, meaning they can only produce temporary retracements or minor pullbacks. Understanding exactly who is dominant helps you stay on the right side of the market flow, rather than constantly swimming against the current. Moving into Section 5, Decoding Market Structure Breaks. These breaks are quite literally where the money is made. The key vocabulary word you need to lock in here is break of structure, or BOSS for short. A break of structure happens when price breaks its structure in the exact direction of the previous trend. It is fundamentally a continuation pattern. It's the market screaming at you that the momentum is carrying forward and the dominant players are still totally in control. Now, what's really interesting is noticing the specific point where the previous high is broken on a candlestick chart. When the price forcefully pushes through that horizontal line marking the break, it's confirmed. The uptrend continues, ultimately leading us right to a brand new buying opportunity. But we have to be precise, right? Notice how crucial internal levels are. Tracking structure directly from the daily open and paying really close attention to internal highs and lows helps you avoid those nasty false signals. It allows you to see the actual difference between a minor, temporary pullback and a true, fundamental change of character in the market. And finally, Section 6, the power of confluence. This is our final grammar lesson for the explainer, and it all comes down to the number 3. There are exactly 3 critical points of confluence that we use. When you stack these 3 factors on top of your supply and demand zones, you are confirming that massive institutional interest is actually there, fully backing up your analysis. Let's break these 3 down real quick. First, psychological levels and support/resistance. Round numbers like 1.1000 or historical price floors seriously help validate your zone base. Second, trend lines. These act as dynamic support or resistance, confirming the overall direction of institutional momentum. And third, Fibonacci retracements. If a key level, like the 61.8% retracement, lines up perfectly with your demand zone, well, that highlights massive collective market psychology. Stacking these 3 tools together literally turns a decent idea into a highly profitable killer setup backed by smart money. Because honestly, if you don't use structure and you don't wait for that confluence, well, you just become another fish taking the bait. Trading without a deep understanding of these market structures makes you the typical retail trader, falling for the exact traps set by professional investors. I mean, they are quite literally fishing for your liquidity out there. So, I'm going to leave you with this final provocative thought. Are you ready to stop fighting the riptide and start reading the market's true language? Because once you start viewing your charts through this highly structured lens, all that random chaos just fades away, and the footprints of the big players become crystal clear. Thank you so much for joining me on this explainer. I genuinely hope this master guide changes how you look at the markets forever. Keep learning, stay focused, and I'll catch you next time.